Pivoting to the global market and how the U.S. fits within that, we have to look at what is happening within China when you're considering, again, renewed lockdowns. So here, this is a chart from the Econ Show. Chinese cities classed as medium to high COVID risk has been increasing. When you look at just the number of cities, they continue to go up. And more of that is obviously connected to GDP. So the biggest concern is, as we said before, the September 10th to 12th Chinese Mid-Autumn Festival, the country's second most important holiday after the Lunar New Year. The antivirus measures have taken a major toll on the economy, travel, and society in general, but China's ruling Communist Party says they are necessary to prevent the wider spread. And the biggest issue that we continue to have is the breadth of Omicron spreading throughout the country, where you're getting more and more Omicron, different variants, and that's creating, again, that panic to try to shut things down. So a total of 103 cities reported new COVID infections. 33 cities were under partial or full lockdown, affecting over 65 million residents. And you just see it creeping up. And again, it's creeping up in a weird way, in a sense, because you're looking at, there's not a huge amount of infections or new infections. It's just the zero COVID strategy. So as people now panic that this is going to spread, you get this push to drive where you're going to go, try to get what you can get. And that panic, again, increases gasoline demand, but it's that blip and then that fail. And that's what we see happening here. It doesn't, we could be wrong. It's going to be, we're going to let the data speak on that. But that's, I think, something that is likely, especially if you look at what has happened in previous times where you had that increase in COVID restrictions. People started to know, are we next? What, do we have enough food? Because when you look at what the CCP is allowing, you get a designated day that you can leave to shop, and that, again, are we going to have enough? What is when it's our day to shop? Will the stores be full? So a lot of these uncertainties, again, drive that panic and push people to get more. So this is where we think that there will be that fade, or I should say a continuation in lower demand for both refined products as well as crude oil within China. Now, this just puts into context some of them. So traffic congestion in some of China's biggest cities has fallen, but you can still see they're still elevated versus January of 2021. So again, that's not going back towards the 2020 period, but it's still a bit more activity. You're seeing some of it come down, and we expect to see a little bit more of this movement lower as that pressure continues to mount on lockdowns, which is going to be the one to watch. Now, as we talked about the margin side, so it looks like there's some demand in terms of Google mobility, but then when you look at the margins, wholesale gasoline premium over Dubai crude sinks on weakening demand. Singapore 92 RON over Dubai actually dipped negative. It is now bounced up a tiny bit, but again, is still on the very low end, and something closer to where we were at in 2020. So right now, the distillate crack can carry that. Like, this is not a hindrance to the maintaining the current runs, but as we get some of this pressure, that's going to become a bigger problem, especially if we get a warm winter, less demand for heating oil, less demand for middle distillate. And again, that's where we want to watch closely to see how is this going to pivot, because if we lose any of that demand in disti, that'll push down the crack and the distillate crack, and it won't be able to carry what we think is going to be the biggest anchor to activity, or at least refining activity, which will be the gasoline side. Now, when we look at OSPs, here you can see that Saudi Arabia slashed OSPs. For October in Asia, it was close to anywhere between $3 and $4.50. To Europe, it was $2. To the Mediterranean, it was about $2, and to the U.S. was a slight increase of about 50 cents. So one of the things that we had talked about when they increased OSPs aggressively, we're like, this was a mistake. I don't know why they're doing this, given the backdrop that we're seeing. It doesn't make sense to raise OSPs to those levels, given the fact that, look, we were already starting to see some cracks on the differential side, and yet they're going to run this up, and the market reacted accordingly. All of a sudden, there was more crude in storage. There was more crude in floating storage. It's just because people, especially Asia, were already getting discounted Russian barrels, and now you're going to run up OSPs. So why am I going to pay this? I'll just buy more Russian. And then as they buy more Russian, well, that opens up the opportunity for West Africa to backfill some of the other places that would normally buy some of this. And again, as that continued to play out, Saudi Arabia and the GCC countries in general, as well as Iraq, saw their demand come down, a floating storage increase, and again, that overhang. So it's not surprising to see the drop. But even with the cut in OSPs, you're still at record levels. And that's why it never made sense to just gun it to that point, because you were already pricing crude at a record point. You were already seeing decent demand at those levels. Why get greedy? Why all of a sudden gun it unless you wanted to put some more in the coffers? You wanted to try to bridge some of this gap because you see some cracks. The 100,000 barrel a day cut was nominal at best, and is really going to have no impact on the current export production market, given where current production is, where current exports are. But we could get that pivot, and as we highlighted in segment 1, if the cap becomes accepted and Russian crude becomes legitimized, and they can get insurance, they can get tankers, well, would it make sense for Saudi Arabia to import Russian crude and export export more of their own crude to supplement for the loss of Russia? So again, buy cheap Russian crude, run cheap Russian crude through the refiner, export more Saudi Arabian crude at a premium, and then take that diesel that was made with Russian crude at a discount and sell that diesel at the market rate, which is going to be at a premium. And then essentially Saudi Arabia wins on the additional exports, wins on the additional margin that they made on the refining side, and they could do that all day. And not to, again, this is just an option out there regarding the cap, regarding things that can happen in general. Because there's nothing, there's going to be a shortfall in diesel. Right now, what they've been doing is importing Russian fuel oil, using that for power burn, and selling the additional diesel that they're saving into the European markets. So if they're already doing that with diesel, is it a huge stretch of the imagination to think they can do that with crude? Again, that's why it's something to watch when we're looking at this. But and again, if Saudi Arabia can get people buying at this price, I mean, it'd be in their best interest to continue to do it. So again, looking at the Northwest Europe, you can see even as prices have come down to 450, you're still at elevated levels. So you're still not getting this huge discount. And that's where, when you start looking at the spreads between Brent, LLS, like Brent is at 89.37, LLS is 86.14. So you still have a lot of staying power for U.S. imports into Europe, West African imports into Western Europe. So clearly we had this big spike up in the 4-week rolling average. As we've been saying, it's closer to about 3.7, 3.8. We had a little bit of that pullback to about 3.5 million barrels a day this week. So as, again, that 4-week rolling average catches up, that's where you'll see that come in at about that 3.7, 3.8 million barrels a day, which has a lot of staying power given where prices are. Even though Saudis cut OSPs, the other GCC nations will cut along the same lines. You're still going to get a lot of support for U.S. crudes. And even though you've gotten that cut, it's still elevated, and you can still see floating storage remains at a high level. It's obviously 2016 was a unique year, but when you look at it versus, that's why we wanted to show 2016 and where we are in that clustering at the bottom, we're still at a very high level. We're still above 2021 levels. We're still above 2020 levels. So there's still, again, a lot of reasons of, are we going to see some discounts? Are we going to see something roll through? to try to incentivize more of that crude getting moved into the market. The problem is it's a seasonally slow period, so you already have a slowdown in purchasing. You still have floating storage at highs, and you're competing against Russian discounts. So again, it's going to be hard to see a lot of this come through unless they get more aggressive on the cut side, on the pricing side. And here just puts a bit more puts this a bit more into context, because when you look at Dubai versus Brent, Brent is only $5 more expensive than Dubai, which still puts them in a fairly competitive place, especially when you think of West Africa priced off of Brent. So even if something is trading $2 above dated Brent for West Africa, you're still $3 cheaper than Saudi Arabia to Europe. So again, you're starting to see they're getting close, but as this comes down, it still makes their crude look expensive versus other options in the market. And given the fact that West Africa continues to struggle to sell their crude, they still have a very slow slate being sold, even though it's a very much reduced slate. That is still creating some of that underlying backdrop as crude oil on the water reaches a new record. So every week so far, over the last 3 weeks, we have hit a new record. We're above 2020 at this point. Obviously, 2020 was coming down. And there's more crude on the water between floating storage and in transit, because we still saw more crude going into transit, which is why storage dropped. But it's just because the crude went in motion, not that it was consumed, but that it is still somewhere in the market. So when we start looking at the different pieces and we see the different flows, you can see how there is more crude coming in. And as the crude goes from transit into storage, you'll see that normalize. You'll see that number recover on the storage front as they go and they park themselves offshore waiting to be offloaded. Crude oil floating storage. Here you can see that it's still it's below 2021. There was that additional crude that got moved into motion. As that starts to show up, again, it'll be more of a flat line, but staying more of a flat line, have a slow creep up, you'll still see some of that connection along, and again, kind of catch up to that 2021 number. Probably stay below it at this point, given the slowdown of purchases that we've seen out of Asia. That will again keep that below that 2021 level. With Asian floating storage, giving you an idea, it's still elevated versus what is normal, but it's below that 2021 level, and we think it'll now kind of stay below that as we've seen purchases slow, given the fairly sizable drop in refinery utilization rate. So refinery utilization rates are slowing, so they're going to stop buying more crude because you have it in storage, you have it on the water. There's no impetus to go out there and try to buy. And here's just an example of that continuous slowdown on the teapot side, going from 61.3% utilization rates to 61.2%. As we expect it to kind of normalize here and start to flatline, but SOEs and the large privates never had the run up that teapots had. And now we're starting to see that again kind of come back to normal. West African floating storage coming back down. Obviously, it's a lot of volatility, but coming back in because they've been cutting rate, they've been cutting differentials, they've been getting more aggressive on price, trying to incentivize more of that to come into the market as they've tried to get more competitive. And even as Saudi Arabia's cut OSPs, it still keeps them competitive in the market. So we should start to see a bit more purchases because it has been slow for October so far to date. And that's, again, going to weigh on and it's funny because they're still struggling to sell crude even as they're cutting differentials, and they've taken exports down again, but it just gives you an idea of kind of some of that softness on the physical side. Here's the China supertanker crude imports, coming back down. You had that spike, but coming back closer to normal, and we expect a little bit more of that slowdown as China has pulled back on some of those purchases. And then U.S. crude exports. Here you can see finished motor gasoline, an increase of 136,000 barrels a day. Distillate, small increase of 21,000. And then propane, propylene, small decline of 37,000, but still elevated. Exports had a drop from 3.96 to 3.43. So right at that, that drop, but still going to stay between that 3.5, 3.7 million. Again, there's always going to be a swing up and down just because of timing, filings, all of those things will create some of that lumpiness. But in general, we're still going to see a lot of support. Motor gasoline, we were expecting it to stay at the highs, just closer to the cloud. Here you can see another surge. As when you think about what Pad 3 is trying to do, they're trying to manage storage because they're going to increase those disty runs. They want to keep things fairly available to have a place to put that excess gasoline that is produced. Distillate staying at the top end of the cloud. We do expect this to give way a bit on a seasonal basis, as well as just some of where the market is. But the market's still very short, and there's still a lot of opportunity, and there's a lot of margin to be made. So it'll still stay elevated. Just I think there'll be a little bit of a normalization as guys start to store some additional capacity for the winter months. Then when you look at ethane came down, but as you can see, it's very lumpy. We do expect to see that bounce back up as we see, again, the shortages remain and the way. So petrochemical demand in general is coming down. So we're getting run cuts, we're getting pressure on the petchem side, but there's that protection of, there's that natural gas shortage. So now you're starting to see countries, and South Korea was the most recent, where they actually want to enrich some of their natural gas with, or I should say LNG, which obviously is natural gas, but LNG into that on the regasification side, they want to use some of that propane and ethane to enrich it to try to reduce total consumption, because when you put propane and ethane back into it, you increase the BTU value, and you could see some of that come back in as petchem demand comes down, so there's going to be more NGLs available, but natural gas availability, LNG availability is going to come down. So try to balance that, which will, again, put a bit of a floor even as some of the petrochemical demand starts to diminish. Then when, again, crude exports coming down a bit, still remaining elevated. But then when you look at propane, propylene, still remaining strong. A lot of LPG still continues to flow into the international markets, especially India. And as people or countries are concerned about availability of distillate for heating, diesel for usage, they're going to, and LNG availability in general, they're going to want to start to store. And it's easier to store propane than it is natural gas, which makes this a highly valued molecule. When we turn to Fujairah, they reported a total amount of 21.739 million barrels. It's a small drop of 233,000 barrels. Stock movement saw a draw in light and middle distillate. So light distillate had a drop of 203,000. Fell to their lowest level since the end of July. But the Asian gasoline complex softened again as concerns of an economic slowdown, I should say the economy slowing as it's actively slowing, weighed on Asian demand. China's demand could be further weakened in September as COVID-19 cases rise. So that's where, again, that disconnect between what we're seeing on the Google mobility side, what we're seeing on pricing, and what other analysts, because this is some comments from S&P Platts, what they're seeing as well. So again, that's why we do believe that light distillate storage is going to increase, not a huge increase, but again, start to go back up, given some of the headwinds we're seeing on the east of Suez. Middle distillates fell 352,000 barrels to 2.672. The gas oil complex in Asia sought fresh cues early September with largely steady near-term demand and supply fundamentals keeping the market even. So that's where you're starting to get some even demand, though dampened by concerns on China's renewed lockdowns. So again, you're getting some of that balancing. There's still those tailwinds, but the headwinds are economic in China, but you're still seeing some of that stability. Heavy resid rose 322,000 barrels to 11.997, marginally below that 12 million mark. Sluggish demand at both the bunker hubs of Singapore and Fujairah weigh on downstream markets. again, as we've been talking about in the Econ show, global trade is slowing, global ship movements are slowing, and here's just another example. Now, when you look at the Brent time spread, November, December, you're pretty stable at about 91. As we were saying, we think that we start to consolidate at about that 90 to $1. We don't think that you get another surge up. But yeah, given you have OSPs coming down, you had some cargoes getting canceled out of Europe, and we'll talk about that in a minute. That you have some of that steadiness at these levels. So then, when you look at flows, so in August, the final August numbers, you got that spike from Russia with the final numbers coming through. In general, BTC Azuri crude oil loadings from the Turkish port of Ceyhan are set at 28 cargoes, which is the highest, or 618,000 barrels a day in October. The daily volume will be the highest since October of 2019. So that's where you're getting, and a lot of this is coming from northern Iraq. So you are seeing more of this coming through. On the other side, Unipec offered 950,000 barrels a day of Olam Bendo at $3.50, more than dated Brent, which is down from $4.65. So again, you're still below where Saudi's pricing. So we see that coming down further. Equinor lowered its price to $2.10 for Girasol, which is lower from $2.85. So again, moving down. Then Shell sold Fortes to Vital at dated Brent plus 80 cents. Shell yesterday pulled an offer for a cargo with similar period at $1.30. So again, you're starting to get, you're not getting a lot of premium coming in. Some of those movements down. Shell withdrew offers for Fortes and Platts window, while Chevron kept one cargo from chains. So again, you're starting to see that stability, and that's what we're talking about. Like, we're not collapsing. You're starting to see some of that capacity marrying here. And that's where you're starting to get some of the financial markets, which were really overstated, kind of coming a bit closer to where the physical market has been indicating at this point. So we do think there is some staying power here at this price, just given where we are on the physical backdrop, even though Angola and Nigeria still remain fairly sluggish, but still seeing some movements as we get the physical markets coming through. Genscape reported another small decline, right in line with where we were in 2021, but very much on the low end. So you do get we do have some additional run cuts in Europe due to pricing and natural gas costs. So that's where you're starting to see some of that balancing act. But we do see this coming back up, because if you look at it seasonally speaking, this is the low point. Then you start to get those increases. So we do see some trend back to the average, which you can see here. The average normally drops. So again, the comps get a bit easier moving back into those levels. Now, when we look at Europe, gasoline had a build of 31. Naphtha had that in general small draw. Gas oil had a small draw of 63. Fuel oil small drop of 10. But again, you're starting to see some of that normalcy come back into the market. But gasoline, when you look at gas oil, you had a decline, and yes, the decline is along seasonal norms, but you're at the lowest you've been at since 2007. So you're still in a dire spot when you think about gas oil and diesel, because if you're concerned about natural gas, you don't have coal, well, do you turn to propane? Do you turn to diesel? And given where levels are, you have to look at the replacement cycle, and gas oil is at a very low level, and there's not a lot out there that's available to go out and get that to replenish. Gasoline moved back higher, still holding in at the 2020 levels. So again, there's still a lot of gasoline that has to be pushed into the market, because you're at a point, if you look at 2020 versus the rest of the other years, you're at a substantially elevated level that is going to be a problem as we progress through the rest, as we come into the slow period for driving in the end of this year. Fuel oil, again, remaining elevated. This is still heading east of Suez, so we still get that swap where gas oil coming west of Suez, fuel oil going east, just based on pricing. Then we look at Singapore, had a drop from 46.7 to 43.8 on the total. But as we were saying, when you look at the average going back to 2007, we expected to just hold steady, right around these levels. And here we are again holding at that level. Light distillate coming down, but still above, seasonally speaking, still all-time high for this time of year. A lot of issues that are continuing to arise, more lockdowns in China, more economic pressure in Asia. So we do believe this remains at an elevated level, keeping pressure on cracks. But even as middle distillate had a small build, you can see that it's still one of the lowest it's ever been, coming back full circle to not enough middle distillate in the global market. Then when we look at resid, as we were saying, resid's just going to hold steady. There's that slowdown in trucking, in bunkering fuel, so we will see some of this get moved into power gen, replace that middle distillate as heavy resid, still and heavy disty continues to be the cheapest option. North Sea floating storage creeping a bit higher. Again, some of that is just some timing delay. We do expect that to continue to move into the market. And as we said yesterday, European floating storage remaining elevated. We do expect that to remain elevated, but that is why we do think that onshore storage is going to creep higher as that floating storage, again, finds its way into the European markets and you get some of that swap out, which should start to happen as the Rhine normalizes a bit. And everyone, I think, kind of tries to prepare as best they can for winter. So that's what we have for you in the EIA show. If you have any questions, please reach out, comment section, Twitter. Happy to have a conversation about it. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.